Good afternoon. Welcome to Trading Hour. I am Reema Tendulkar with me, Surabhi Upadhyay and Pavitra Parekh, and there has been a sudden turn in the market sentiment. You know, we were bobbing up and down below the flat line, hovering around 17,800, but suddenly in the last 10 minutes, markets have fallen close to about 30-40 points, and now the Sensex is down 200 points with the Nifty lower by 50 points. Mid-caps too, which were holding up and outperforming, have now completely flatlined. The advanced decline ratio is just about holding up in favor. There you can see. Last 20 minutes is where the sell-off began. The culprit is really the IT index. So the Nifty IT index is down 2.3%, so that's extending its sell-off. And the Nifty IT stocks contribute about 15% to the Nifty in terms of weightage. And across the board, you are seeing deep losses of about 1.5 to 2%. Pull up the contribution plate and you would see Infi and TCS combined are shaving off more than 40 points on the Nifty right now. There is the contribution plate. 26 points gone on account of Infi, and TCS is down close to about 12 points. That's the amount it's taking away from the Nifty. Crude prices too have increased overnight now to $87 per barrel. 2 days back, we were at $85 per barrel. So that on the sidelines is hurting the sentiment. Nifty Realty is a segment which is, at least this so far, holding up pretty okay. This week, it's rallied close to about 4.5%, and the last time I checked, the Nifty Realty Index was still holding up in the green. But we've had a couple of big movers this week. It's been a 4-day week, but Eicher Motors has rallied 8%. Tata Motors has rallied 6.5% this week, and courtesy the rise in oil prices, ONGC too has seen a pretty bumper week so far.
Oh, yes, absolutely. But I think the market's looking quite interesting, Reema, as you mentioned, this sudden fall that's come in. It's IT for sure. It's also banks. IT was weak right from the morning, but what's kind of tipped the scales is banks. Pull up the Nifty bank and you'll see that index slightly trending down as well. And you have names like Kotak, IndusInd Bank, Axis Bank. They're all on the red side of the screen. Even the biggies, HDFC Bank, ICICI Bank, they're beginning to now come off their earlier morning levels, and that's exerting downside pressure. In any case, Pavitra, I guess we woke up to mixed cues, right? On the inflation front, we had good news from India and from the US. TCS was negative, and obviously the Fed thinking that there is going to be a recession because of banking issues. So we are also at a level in the market where there was a lot of resistance coming in at the 17,800 level. Yeah. For the time being, it seems like the bears don't want to give up on this level so easily. So interesting fight going on.
Interesting. I mean, this is coming after 8 straight days of gains as well, right? So we should keep that in mind. Like Surabhi was pointing out, a lot of the banks, a lot of the smaller banks as well. So take a look at CSB, for instance, Bandhan in the past few minutes. These ones are the ones which are coming in for deep cuts. Apart from, you know, the larger names that Surabhi mentioned, it is the mid-cap IT names which are continuing to lose, and they've actually slipped even more. So that entire pack continues to be in the red. What's holding up today for a change is the consumption pack. So take a look at some of the larger consumption names and you will see today they're holding up quite all right. Reliance is in the green. And you know, we were talking about the banks. It is likely to be a lot about that as well in the coming few days, right? In addition to IT, because you have HDFC Bank, which declares results on Saturday. A lot of the big US banks also are likely to post results today and tomorrow. So you have the likes of Wells Fargo, JP Morgan, just naming a few. But of course, big focus on that amidst what we are seeing going down with the regional banks. So it will be a lot about that. But anyway, let's get back to the top story that we were talking about. Of course, it is TCS, and also what we can really expect now from Infosys. So Reema, first just take us through the key takeaways that came through from TCS's numbers. I know there's a lot that we've been talking about, but if you had to break it down and tell us just the top few takeaways.
Well, first, let me just start with the basic numbers. Yeah. It's a miss on revenues and on margins. Constant currency revenue growth at 0.6%. EBIT margins at 24.5%. Now, growth has significantly fallen short of management's expectations. You know what they told us in the interview? That they were penciling in a recovery in North America at the beginning of the quarter. But actually, the sentiment turned on account of what happened in the banking crisis, particularly in the month of February and March. As a result of which, the growth has come in at 0.6% versus their estimate of 1.5 to 2%. That is the kind of growth that they were anticipating, but it ultimately came in much lower. BFSI is clearly a problem area. The growth there has slowed down to single digits, 9.1%. Order wins are strong. The only issue with order wins is that the companies have signed on the dotted line. They're saying that we are going to give you the order. But what if they say that instead of the order starting on 1st of May, it starts on 1st of September, right? Because discretionary projects are being put on hold. So that's the risk when it comes to an order book. But generally, there is visibility. And the management commentary clearly indicates that there is uncertainty and they can't pencil in what the near term is going to be.
All right, so those are some of the big takeaways. In fact, here's a word from the management. Rima spoke to them in the morning. So listening to what they had to say on this constant currency revenue growth that came through and as well on the order deferments that we might see.
Later part of the quarter, because of the uncertainty that came around the BFSI sector and its implications on the overall macroeconomic setup. That's where the miss in terms of what we were expecting versus what North America has been growing very strongly for us. If you look over the last 8 quarters, for the first time in a long time after the pandemic, we have actually had a sequential degrowth in North America. So we were thinking that the quarter should come in at somewhere in the 1.5 to 2% range. That would have also met the other side of it. It has come in at 0.6. So that's the extent of the miss. And almost entirely, I would say that I would think North America is where the shift is.
Our exposure to US regional banks is very immaterial. Like in an overall scheme of things, I would say on a revenue basis, it could be less than about 3% of our revenue. It's very immaterial. We want just 3% among banking alone, right? The uncertainty is still lingering and it will be there for some time. So customers are likely to prioritize certain kind of projects over others.
All right, that is the word coming in from the TCS top team. But while Rima was chatting with the management and was at the TCS headquarters all of this morning, Surbhi, you were really going through what brokerages have to say, and they're really not, decided on this one. Very divided views coming through.
Oh, and, stock target prices ranging from 2,700 all the way to 4,500. Yeah. So we're really talking a wide range, a wide spectrum over here. This is really, the TCS stock is one that has divided the street right down the middle. So let me take you through the bull view. Now, the bears view, and of course, in a bit, we'll also get to the fence sitters. The company's fourth quarter earnings miss has got the bears out in full force. JP Morgan has been underweight on the stock for a while, with possibly one of the lowest target prices on the street at 2,700. The bank says the BFSI weakness was unexpected and the uncertainty on tech spends will lead to a softer first half for TCS. JP Morgan has cut its revenue and EPS estimates by 1% and 2% respectively. The next big bear is Nomura with a reduced rating and a target price just above JP Morgan at 28.50. Nomura says near-term business visibility is low and also points out that headcount addition in the fourth quarter has been weak and TCS has missed its margin guidance for the year. Citi is also part of the bear camp with a sell call and a target price of 3,000, that's slightly above Nomura and JP Morgan. The bank feels valuations are still high and street estimates on margins may have to be trimmed down given the impending wage hikes. Now let's see how bulls are seeing the TCS story. Macquarie has one of the biggest target prices on the stock with an outperform rating with a target price of 4,510 rupees. That's a 40% upside on the stock from current levels. Macquarie's argument is that revenue and margin miss is due to temporary issues. The brokerage argues that deal wins are still strong and that the business is poised for growth. The brokerage expects TCS to get back to its targeted margin band of 26 to 28% this fiscal year itself. The sentiment is echoed by Bernstein, which points out that the company's order book remains healthy, even though there is uncertainty on BFSI spends. Bernstein has an outperform rating on the stock. Their target price is 35.60. That brings us to CLSA, another TCS bull with a target price very close to Bernstein at 3,550 and an outperform rating. Now, CLSA says TCS's structural strength will support the company in this uncertain spending environment. And it says that there's a fairly compelling argument from the bull perspective even now. So there you have it, arguments coming in both from the bull as well as the bear camp. But Pavitra, that's the clear bulls and the bears, and then there's always the grey in between. The fence sitters, what are they saying?
There are a few of those as well. So let's just run through all of the brokerages that are pretty much sitting on the fence, like you said. The first one comes in from Jefferies. They have a hold rating on the stock with a target price of 33.75. You then have Morgan Stanley, which has an equal weight rating on the stock. They have a target of 33.50, so pretty close there. Now, Jefferies has sounded a note of caution on the client uncertainty as well as subdued headcount addition. So that's what they're a little bit worried about. It has cut earnings estimates by 2 to 3%, and they now expect TCS to deliver 6.7% constant currency growth. Morgan Stanley then says it's not yet clear if client sentiment has troughed out or not. The brokerage also believes that valuations are still higher than the long-term average, making the risk-reward a little bit unattractive. So that's what you have it. That's the black, the white, and the grey of it all. Like Surbhi was saying, street is completely divided on, how you should look at TCS and their call on this. But Reema, TCS is done now. Okay, now you still have a very busy day before the 3-day weekend.
No.
So Infosys
3-day weekend, don't forget.
3-day weekend, we know you need it.
And
before that, how is Infosys likely to fare, and how does it really, compare with TCS? Take us.
Okay, so first the numbers are anticipated about 3:45 4 p.m. The press are scheduled at 4:30 p.m. Now let me quickly run you through the key numbers from Infosys this time. Dollar revenue growth of 1.3%, and this is likely to be less than TCS even after the miss on TCS. 1.33% dollar revenue growth. Constant currency revenue growth is also seen quite muted at just 0.4%, and again, this is lower than TCS's missed constant currency revenue growth. Margins are anticipated to remain at the same level as they were, so no change in Infosys management, something that we had seen in the case of TCS as well.
Okay, so that is on what we can really expect from TCS this time around. But Reema, you've been telling us for the past few days that with Infi, it's really the guidance which is going to be the main thing to watch. So what should we expect now?
Well, right now, consensus estimates is that it's going to be about a 6 to 8% constant currency revenue growth for next year. But this is going to be, significantly slower than the growth that they're going to clock in this year. They're going to end FY23 with a 16 to 16.5% growth, even after accounting for a muted Q4. Right? So growth rates are going to really fall off on account of a high base and general slowdown. There are a few people who believe growth could be 5 to 7% as well. The key is going to be the margin guidance. Now, Infi typically guides for 21 to 23%. Last year, what they did is they brought down the margin guidance to 21 to 22% on account of a high wage bill. Okay, so this year they're going to end with margins between 21 to 22%. Now the street says, since the supply side situation is easing, you're not paying a big premium to higher laterals and your wage bill, your freshers, etc. is coming down, then you need to go back to what your margins used to be. Right? Last year was an aberration in terms of a high wage bill. So now the key is going to be a margin guidance of 21 to 23%.
If they can go back to revert back to the
they need to
original
revert
band.
back to what the original band basically is. And if they can do that, then the street will have confidence that indeed the supply side situation is easing.
Okay, so I think there's a lot to watch for in this. But Reema, what could constitute a clear disappointment? I mean, if they don't up their margin guidance, will that be the biggest disappointment, or will just headline, top line revenue growth, can that be the big risk?
I think both, right? 6 to 8% is what the consensus is. There are a few analysts who believe 5 to 7% is also possible. If they come out with, a 5 to 7% kind of growth, it would be a bit disappointing, right? And again, if they don't up the upper end of the margin guidance, then it will be a disappointment, right? Okay. Current margin guidance is 21 to 22%. Street is saying it should come up to 21 to 23%. So at least the upper end of the margin guidance needs to be raised. So a low number, 5% type of constant currency revenue growth, and no increase in the margin guidance.
Okay. All right, got that. Infosys has that famous under-promise and over-deliver line as well, right? But Reema, lastly on the stocks, just take us through how the valuations look for these, because TCS is more expensive, right?
Yeah, so just, on that point that you made about how, Infosys tends to under-promise and then over-deliver, that is the case. So whenever they come out with a guidance, the street is going to look at it fairly conservatively. You know what they did last year, FY22? They had started the year with a 13 to 15% revenue guidance. Then every quarter, in June, in September, and December, they upped it. And they finally ended with 16 to 16.5%. So this time as well, given the uncertainty, there is a possibility that the guidance is going to be fairly conservative. So the management commentary is going to be watched very closely. In terms of the stock performance, Infi has underperformed TCS. One, on account of fears of what the guidance is going to be, and two, because there have been some exits at the top level. Mohit Joshi, remember, moved to Tech Mahindra. They lost Ravi Kumar to Cognizant. These were two precedents right below Salil Parekh, the CEO. So that's the reason why Infi has been an underperformer versus TCS. But let the valuation plate come up. Now, Infi's valuations are 21 times forward multiple, lower than TCS. right? But for the last, let me get that number, 4 years in a row, Infy has beaten TCS in terms of its annual growth. In FY20, FY21, FY22, and now FY23, the growth rate is going to be higher, right? So if that's the case, and even next year, if the street believes that Infy is going to grow faster, then shouldn't the valuation differential also start narrowing down, right? Or catching up in some way. So, I think there is going to be some chatter on that.
I wonder if this is going to be one year where Infy guides conservatively because the environment is conservative and they basically mean what they say.
And the street is going to say, no,
I think you're going to do better.
Oh, well, it's going to be an interesting evening for sure. Thank you so much for all of the details and the analysis there, Rima. Of course, you can catch Rima with the Infosys management. We'll have all the action live right here on CNBC-TV18. It kicks off at 4:30 this evening, so keep it with us.
Welcome back. You're still tuned into Trading Hour. The market has slipped like we were telling you. So 60 points in the red for now. And it is the mid-cap and small-cap index also which are coming under pressure. So you have the advanced decline, which is absolutely neck to neck right now. What's holding up really well, however, is a lot of the auto names. So the likes of Eicher, Maruti holding up quite well right now. On Eicher, of course, there's that note that's come through from Goldman Sachs. A lot of the consumption names also for a change doing well today. So that's what's happening with the market. But let's talk about the commodity space now. Manisha joins us and she's going to tell us what's going on with crude prices once more. Manisha.
Pavitra, thank you so much for that. At $83 a barrel, it's a 5-month highs that we are trading at for the crude oil prices. The overnight gains have been at 2%. For the week, we are up by nearly 3%. And the last 4 weeks, crude prices have been posting positive returns. So we are up 16% in the last 1 month itself. There is support coming in from almost all quarters. When you look at the U.S. markets, they may start refilling strategic petroleum reserve. Remember, for last 18 months, the U.S. SPR has been giving out crude in the open market to ensure that there is enough availability, one, and two, that the prices do not rise much there. SPR reserves are at the lowest at November 1983, and with the statement suggesting that the U.S. could be buying right now has added premium to the prices, though it seems a bit difficult because U.S. did not buy at $70 a barrel, so at 83 and 85, the markets do believe that the U.S. might want to wait this out. This is the report coming in from EIA, where they're anticipating 1.4 million barrels per day of a demand growth in this year, and that could increase going forward to 1.8 million barrels per day. The markets do believe that the recession fears would go off and the Chinese demand would come back. So would the Asian demand be. So the 2024 demand estimates are higher than what we are looking at in this year. The IEA also says that there is expectation of a tightness in the second half of 2023 because of the OPEC-led output cuts, the voluntary cuts that we've seen come in from Russia as well. And then there are concerns about supplies from various other producing countries. Russia, for one, had started to cut production in the month of March and April. And in the month of May, they are going to be increasing those output cuts there. From Iraq's Kurdistan, we already have seen pipeline flow exports continue to decline, and that has led to support in the recent days coming in for those markets as well. The demand estimates from China are also on the higher side. On a month-on-month basis, Feb and March, both of these months have performed better. And the month of April, the first half that we've seen, the first week that is, we've seen higher loadings already there. The only reason that you're looking at 0.25% to 0.5% decline right now is because of the recession concerns, the U.S. inflation easing, and the expectation that 25 basis point of a rate hike is still on cards.
Okay, got that. Thanks very much, Manisha, for all the details there. We will take a break on that note. On the other side, we'll discuss market technicals and track this fall. Ashish Kayal of Wave Strategy Advisors joins in. Welcome back. Let's shift focus to some stocks that are making it to the headlines today. And AU Small Finance is definitely one of them, surging in trade almost 13-14% higher after the Reserve Bank approved the extension of the tenure of the managing director and CEO of the bank. Ritu is joining in with the details as well as some commentary from the street. So, Ritu, I think this announcement is working extremely well. Tell us what exactly the RBI said and how should we interpret this move?
Well, the investors are clearly excited because RBI has approved the reappointment of Sanjay Agarwal as the MD and CEO of AU Small Finance Bank for 3 years until April 2026. And the tenure here is important, and clarity and continuity is what the street really likes. Remember, the board had already approved Sanjay Agarwal's reappointment in January last year. In addition, what RBI has done is it has also approved the reappointment of Uttam Tibrewal as the whole-time director of the bank for 3 years. What this does is it removes a big overhang on the stock, because in the context of the 1 or 2 year renewals that have been granted by RBI in some instances, take IndusInd Bank for example, this 3-year extension for AU Small Finance Bank is definitely a positive outcome. So Kotak Institutional Equities believes that the fresh development addresses one of the key discussion points for investors, and now the interest is going to squarely shift back to the bank's operating performance. There, of course, we've been seeing AU Small Finance Bank indicating strong trends, whether it is collections or asset quality. The growth in advances and deposits has been healthy for the bank as well. Now, Morgan Stanley is overweight on the stock with a target price of 860 rupees. It expects the stock to stop derating given the full tenor extension the MD CEO has got and a peaking interest rate cycle. Going ahead, it says in the next few years, it sees a strong re-rating of the stock. In fact, Citi also has a buy rating on the stock with a target price of 740 rupees. It says that RBI's approval reflects a stance of confidence, especially when you look at the tenor, and it expects the stock to unwind and see some improved visibility on the bank sustaining an ROA of around 1.9%.
Thank you very much for that, Ritu. Now let's move on and talk about Eicher Motors and Ashok Leyland. Goldman Sachs has initiated coverage on these stocks. Sonia is here with the details. Sonia.
Well, at the onset, I just want to mention that, the auto stocks have been the big movers both this week, this month, as well as this year. So if you look at it, names like Tata Motors, Bajaj Auto are all up about 20% for the year. And a lot of brokerages have written positive notes on this space. In fact, Goldman Sachs, as you rightly pointed out, has written a note this morning where they've initiated a buy on Eicher Motors. They have a target price of 3,660. Now they say that over the next 5 years, Eicher Motors has the least amount of impact because of the electric vehicle disruption that the industry is facing. They say that Eicher has given a longer R&D cycle and a higher bar as far as specifications are concerned for premium electric motorcycles. So it is sort of in a league of its own and may not get impacted by the EV disruption that we're seeing. The margin dynamics are also favorable from improving 650cc mix with international market expansion. Also, they have a low sensitivity to higher interest rates, so they won't be impacted too much if interest rates continue to move up and that continues to impact demand. They also speak about how one of the big catalysts include the improvement in the international business. There are 10 new products in the pipeline. The response to some of their new products like the Hunter 350cc has been very good. The Super Meteor 650cc and the rural market launches have also played out quite well. Let's move on to Ashok Leyland, where Goldman Sachs has initiated coverage with a neutral stance, and they have a target price of 140. Now, they are a bit cautious. The reason for their neutral stance is they say that the fast growth in the commercial vehicle sector in the past few years could start to normalize now as we enter the mid-cycle phase in the Indian CV market. Although they expect a normalization of the growth, they're still looking at a 25% EBITDA compounded growth for Ashok Leyland over the next 3 years, driven by a steady progress in the LCV business. And finally, they talk about how the company has plans for some new modular range as well as an alternate powertrain. All of that could lead to further upside in the business. Back to you.
All right, Sonia, thanks a lot for getting us all of the details on these notes on Eicher as well as Ashok Leyland. Eicher is up almost 9% for this week. So that is the kind of move that we've seen in some of the auto names. But let's also get you a technical check on the market now. Ashish Kayal joins us from Wave Strategy. Ashish, we're just marginally off the day's low right now. This is, of course, coming after 8 straight days of gains, but largely also on account of what we're seeing with IT. Do you think for the rest of the session, we're likely to see more of a fall, also considering what's going on with the banks right now?
Hi, morning to you and all the viewers. See, if you look at Nifty, it has been in a rotational rally. Initially, the start was, we can see Reliance contributed, then we saw the real estate stocks, then we are seeing the auto stocks contributing. So it has been, and the pharma as well. So we are seeing a rotational rally in this, and that's why the dip in this entire up move of 8 to 9 days has been very minimal. And every dip has been bought into. So I would not try to catch a top here. I think Nifty is headed much higher from here on, as long as we do not close below the prior day's low. So it has been 8 to 9 days when Nifty has not closed below the prior day's low. So let's see if today also that can be sustained. But the momentum is not that much because we are seeing a move of approximately 100 points, 90 points on the upside also. So the momentum is slower and steady, which is a healthy sign. The VIX has been falling, which keeps the trend on the upside for now. So any dips, use that as a buying opportunity for the target of somewhere around 820 on the upside. The support for Nifty is around 17,690. So for today, possibly a range bound movement can be expected, but buy the dip with 17,690 as a stop for the target of 17,820. And as far as Bank Nifty is concerned, we can see Bank Nifty is outperforming today, showing some resilience. So the trend for Bank Nifty also remains positive for now. On the downside for Bank Nifty, the support is at 41,350 levels. And as long as that support is intact, we can expect it to again touch that 41,700 on the upside.
Ashish, you said Friday's intraday low is a very important support, and you want to make sure that the Nifty doesn't breach that. Could you refresh our memory and tell us what the number is? The Friday
sure.
intraday low on the Nifty? Yeah.
So what I would say is that in the last 8 sessions, Nifty has not closed below the prior day's low. So the prior day low, if we look at that, the level is 17,717. So if we have to ensure that Nifty does not close below 17,717 in today's session. If it doesn't, then the trend still remains buy on dips and we can expect a move on the upside. So the level to keep a watch is 17,717 on a closing basis, and for intraday it will be 17,690 level.
Okay, I thought you said Friday, so I was wondering, not prior day. So it's the prior day low, which we need to respect. Okay. Any stocks?
Yes, absolutely. Yes, the first stock on the buy side is from the healthcare space, Apollo Hospital. We can see some buzz around pharma and healthcare space. So Apollo Hospital formed a double bottom. There has been a good volume pickup that we can see in today's session. Possibly expected that the stock will move towards 4,750 levels on the upside. Long positions can be created here. Stop loss can be maintained at 4,300. And the next stock on the buy side is going to be HDFC Life. And after a long time, we are seeing some positive traction, smart recovery from the lows of 460 in HDFC Life. The momentum looks good even now. There was a gap up opening and it's sustaining there. So HDFC Life can be a good buy. Maintain a stop loss of 506 for the target of 562.
Okay, thank you very much for that. Slip into a break. On the other side, we'll discuss market fundamentals. We'll talk global as well. Abhilash Narayan. Okay, let's talk about some more earnings expectations. And no, it's not from the IT pack or Infosys. We're going to be talking about HDFC Bank, which reports its fourth quarter numbers on Saturday. Abhishek is joining in with the key expectations. Abhishek.
Well, HDFC Bank will be reporting its numbers on Saturday, and Street is anticipating the best NII growth on a YY basis in last 31 quarters. We already have the business momentum for Q4 FY23, wherein the deposit momentum is robust. On a YY basis, they are the best in last 11 quarters, coming in at nearly 21% growth. And on a sequential basis, they are the best in last 20 quarters, coming in at 8.7%. The loan growth on a YY basis at a little under 17%. Is perhaps at a 5-quarter low, but sequential loan growth of 6.2% is perhaps the best in last 4 quarters. The CD ratio or the credit deposit ratio is at 8-quarter low of 85%. However, the CASA ratio has remained stable and improved on a sequential basis. So ex-pool, the loan growth is about 17% YOY and about 6.23% sequentially. To watch out for the NII growth, that will be on a stronger side. So net interest margin can expand YOY, but it may decline on a sequential basis. Analysts are expecting anywhere between 5 basis point to 10 basis point decline in net interest margin on a sequential basis. Slippages are expected to be at 6,000 crore as per Phillip Capital estimate. Remember that in the previous quarter it was at 6,600 crores. Kotak Securities is estimating operating profit growth of 12.6% YOY and a decline of 3% sequentially. While in this, a large part could be played by the fact that OPEX could remain elevated. Credit cost or provisions are likely to remain under control or moderate from the previous quarter. Asset quality to remain stable or improve quarter on quarter. We'll watch out for any impact from the unseasonal rain on the agri portfolio. So our poll suggests NII growth of 25% on a YY basis and about 2.8% sequentially. We are working with a profit growth of nearly 21% YOY and a decline of a little under 1% on a quarter on quarter basis. Back to you.
Okay, all right. Abhishek, that's the big one, and we'll watch out for it over the weekend. Thank you very much for giving us a heads up on HDFC Bank. So earnings season kicking off full throttle. Let's take the conversation forward. Abhilash Narayan, Senior Investment Strategist, Group Wealth Management at Standard Chartered Bank, is now with us. Abhilash, thanks very much for joining in. Great to have you on the show. We're in interesting times because the litmus test has begun, right? Corporate earnings, and they're coming in thick and fast now. Just your overall thoughts before we start talking IT or what banks can deliver and how you're poised. What have you made of this whole consolidation phase that the market has been in, the slight uptrend that we've seen in the last week and a half or so? Do you expect the market to continue to be in this band, or do you think that we can perhaps start getting some sort of an up move or maybe a down move, basically a directional move over the next few weeks?
Well, on our end, we've been highlighting that the recent rally that we have seen in stocks could actually be a good opportunity to rotate out of equities and allocate a bit more to bonds. So from our perspective, we see a very high likelihood of a recession in US and Europe, so around 80% probability of that happening in the next 12 months. And that's why if you look at the rally we've seen globally, we think that it's starting to look a bit frothy. So in US, for instance, most of the rally has been driven by PE expansion. And to a certain degree, that's what's happened in Europe as well, with German and French indices, really hitting all-time highs or multi-year highs. So, we think that if you want to stay in equities, rotate into Asian equities. At the margin, investors should consider increasing allocation to bonds, given that we are probably close to the end of a rate hiking cycle for most of the major central banks, RBI included.
So you're saying you would prefer bonds over equities right now in the Asia-Pacific region?
Yes, that is true. So at a headline level, we prefer dollar-denominated bonds within Asia as compared to equities. And that's down to a very simple fact. So if you look at the all-in yields that dollar-denominated bonds offer in Asia, that's higher than what you get in some local currency markets as well. And that's happened for the first time since 2009, 2010. So that's quite attractive in our opinion.
So what would be your equity allocation, the recommended equity allocation, if an investor has a choice between dollar-denominated bonds and equities? What was it, say, a year back? And what is the equity allocation down to?
Well, if I recall correctly, it varies according to different investment profiles, but we were around 10% overweight equities maybe 12 months back, and that has now shifted to around 10% underweight. That being said, we do see Asia as a bright spot. Leaving aside US and Europe's growth concerns, we think Asia is the bright spot as far as growth is concerned. So we think that, if you think about Chinese equities, they'll deliver earnings growth of around 16.5%. And for Indian equities as well, we are looking at a 15% EPS growth for FY24. So, valuations are a bit stretched, but we still think that from a earnings growth perspective, we are on solid footing for Asian equities.
All right, got that. Abhilash, thanks for joining us. This is Pavitra. If we can talk a little bit about the US now, because we did get that inflation print that came out. We also had the Fed minutes last night. Take us through how you're reading this. Inflation has eased, but it is the Fed minutes which are sounding a little bit more cautious, right? At least in terms of what they're saying on a recession in the second half of the year. Your own reading on this?
Well, if I take inflation print, I think it's something for everyone. So if you are in the camp that inflation will come down, obviously look to the fact that year-on-year inflation declined from 6% to 5% at a headline level. But if you are one of those people who think that inflation is sticky, then you could look towards the core inflation. So the inflation figure that excludes volatile components such as energy and food. And actually, if you look at it, the core inflation increased from 5.5% in the last reading to 5.6%. And I think given the fact that inflation has proven to be sticky and Fed has said that it will remain data dependent, we think that the latest inflation print hasn't given Fed enough backing to pause the rate hiking cycle. So we think that short of a renewed scare in US banking sector, Fed will hike rates by 25 basis points to 5.25% in the upcoming meeting in early May.
Okay, so Abhilash, I'm going to now come back to Asian equities and India. Given that in any case you are a little more optimistic on bonds than equities, to go back to my colleague's question, in the portfolio, how much equity allocation are you recommending right now? Within that, how much would be India and why?
Well, if I just take an average balanced allocation, right? You can have a conservative or a aggressive allocation. If I take a balanced allocation, we are looking at equity allocation of somewhere around 35% versus a benchmark of around 45% if you were neutral on equities. So we are about 10% underweight on equities. Now, if I talk about Indian equities allocation, I think at a headline level, we are neutral on Indian equities within Asian context. And one of the things that really stands out to us is that we had moved from overweight to neutral on Indian equities at start of the year, and that call has played out. India has underperformed global and Asian equities. But what that has meant going forward is that valuations have become less expensive on a relative basis, right? So if you look at the Nifty PE, that's broadly in line with long-term averages. And if I look at the Nifty PE versus MSCI Asia Japan, it was trading at a 120% premium back in October 2022. Now that is down close to 50% premium. So on a relative basis, Indian equities have become less expensive. And I think going forward, that along with the strong earnings growth should mean that Indian equities perform broadly in line with Asia Japan equities, but they have a high likelihood of outperforming US equities in our opinion.
Got that. What will make you go overweight on India? Currently, you're neutral. What would it take for you to go overweight?
I think a couple of factors. So first one is we have this overhang of a potential recession in US and Europe. And while India on its own has fairly strong growth trajectory, given the interconnected nature of financial markets, if we do end up seeing a recession in US, then that will have a negative impact on global equities, Indian equities included. So, if we do get indications that US recession is becoming less likely, or, the Fed is pivoting towards cutting rates, which reduces the risk of recession, then that could be a positive catalyst for Indian equities. And secondly, I think it's the relative trade-off between expected earnings growth and valuations. So, as I mentioned, Indian equities are trading at around 50% premium to Asia Japan equities. So if we do see further underperformance of Indian equities, and that leads to that compression of that premium that Indian equities are trading at, then that could actually be something that makes us a bit more optimistic on Indian equities going forward.
All right, Abhilash, we're going to leave it on that note today, but thank you as always for taking out the time and speaking to us. That is Abhilash Narayan of Standard Chartered talking about the outlook for the market, also saying that on India, they did turn from an overweight rating to neutral at the start of this year, but several factors that he mentioned, perhaps the Fed cutting rates as one of them, could make them change their stance. Quite positive on Asia as well within the broader global markets. With that, we are going to get into a short break now, but when we come back, there's lots more that we're tracking, so stay with us.
Welcome back. Here with us on Trading Hour, and the market continues to be down 52 points lower, but it's not exactly breaking out or breaking below support levels either. In fact, there's a bit of a recovery, attempted recovery from the lows. With that, let's move to another important development that came in from the RBI. The central bank has released a draft circular on fair lending practices, penal charges in loan accounts. Ritu is here with more details. Ritu, this was something that the RBI, I think, mentioned in the policy, not this one, the previous one, to kind of streamline the system in which banks are penalizing people for defaulting on their loans, right? So what is the latest and what does this circular say?
Well, absolutely. That's what RBI is trying to do, because it's pulled up banks and other lenders for instances of overcharging borrowers in the guise of penal interest rates and levying divergent charges across the system, and thus come up with a draft guideline on these charges to protect borrowers and bringing in a more consistent policy of levying these charges across various entities. So these draft rules, they emphasize that the interest rates on credit facilities and conditions for resetting the interest rates will have to be strictly governed by the relevant authority or relevant regulatory instructions that have been issued by RBI. It prohibits lenders from introducing any additional component to the rate of interest and says that penalties cannot be used as revenue enhancement tools. So far RBI had given lenders autonomy to formulate board-approved policies and levy penal rates of interest, but given recent instances of overcharging leading to a lot of customer complaints, it has brought in these new rules. Importantly, these do not apply to credit cards, which is again positive for banks and card companies. Now, these draft rules also say that the levy of any penal charges cannot be in the form of penal interest. It has to be called charge and not interest, so there's a change in nomenclature. And there should be no capitalization of these. That is, you can't charge compounded interest on these charges. It also says that the quantum of penal charges will have to be proportional to the default or the non-compliance with the terms of the contract beyond the threshold, and that threshold cannot be discriminatory within a particular loan or product category. Now, banks will also have to lay down a clear board-approved policy for formulating these charges. As far as the impact is concerned, for banks, it's a relief really, because there's no one-size-fits-all penal charge which RBI has prescribed. It is still up to the board, but there could be some loss of income in instances where there is an incidence of interest rates being charged on penalties, and the impact, however, should largely be manageable for banks, according to various industry experts.
Okay, thank you very much for that important update. We'll slip into a very short break. When we return, we get you a special deep dive into India's air cargo market as a part of our special segment, Clutter Breakers.
Welcome back. You're still tuned into Trading Hour. Now, earlier this month, SpiceJet hived off its cargo business into a separate entity. They called it Spice Express, narrowing its focus on air cargo business. Now, a deeper look at this market shows that India's international air cargo is almost entirely dominated by foreign operators, and Indian players hold just a meager 5 to 6% share over here. So what are the reasons behind this huge gap, and how can we improve? We have Madiha at the big wall to take us through this edition of Clutter Breakers.
Let me start with a wider view of the size and scale of India's air cargo market. The country's total inward and outward shipments stood at 3.14 million tons in FY22, and the volumes are expected to remain the same for FY23 as demand is yet to bounce back to pre-COVID levels. Of the 3.14 million tons, 1.29 million tons were domestic cargo and 1.84 million tons were international cargo. And of the 1.84 million tons of international cargo, a lion's share is taken by foreign air operators who control around 94 to 95% of the market, and the remaining 5 to 6% that domestic players handle is also largely done through the belly space of wide-body passenger aircraft, mostly by carriers like Air India and Vistara. So what is leading to this huge gap? The key reason is Indian air cargo airlines can't carry cargo for long and ultra-long haul destinations due to the lack of dedicated wide-body freighter aircraft, and this is where foreign players come into the picture and dominate the Indian air cargo space. Apart from carrying cargo in the aircraft belly, there are dedicated foreign freight carriers, and look at their fleet. FedEx has over 400 aircraft, United Parcel Service has 290 planes, DHL has 215, Qatar has 27, Emirates has 11 freighter aircraft, and most of these are wide-body planes. Now, Indian carriers, meanwhile, have only 14 dedicated freighter aircraft, and all of them are narrow-body planes, which means they can't fly to destinations like the US and Europe. Now, while this is a major limitation, the domestic industry claims they don't have a level playing field to compete with the foreign giants. So what exactly are their complaints? Number one, they say Indian air cargo operator has to pay a hefty customs duty for leased aircraft registered in India. Second, Indian cargo airlines are not allowed to operate aircraft that are over 20 years old, but at the same time, foreign airlines are allowed to fly into India with aircraft that are over 20 years old. Apart from these issues, domestic players want the government to create a dedicated airport to handle all kinds of cargo and introduce a unified customs policy across airports for faster clearance of shipments. They also want the government to bring a trans-shipment policy to ease the transport process and make India an international hub for air cargo transport. Now, the government has set an ambitious target of taking India's air cargo to 10 million tons by 2030. Industry representatives tell me the government will have to make policies that will bring more players into the market and help existing operators expand their capacity to achieve this target.
Madiha, very interesting there. Thank you very much for highlighting that. Out of time on Trading Hour from the entire team. Thank you for watching.